Most of us have heard about compound interest and the idea of a financial snowball. You put money in, you reinvest what you earn, and over time, your wealth is supposed to grow on its own. It sounds simple, but there's a part of the story that almost nobody talks about. Compounding feels very weak in the beginning. In fact, for most people, it doesn't start to feel truly powerful until a portfolio reaches somewhere around $100,000. That's the point where growth becomes visible and momentum finally shows up. The challenge is obvious. Very few people start with that kind of money. So the real question becomes this: how can someone begin small and still build a portfolio that eventually reaches that level? In this video, I'm going to break down why investing feels painfully slow at first, why the $100,000 mark is such an important turning point, and practical ways to reach that level without needing a huge salary or a massive lump sum. You'll see two different approaches, one that uses the smallest possible starting investment, and another that relies on tiny daily contributions. By the end, I'll show you how both paths can eventually lead to $1 million portfolio producing over $5,000 a month in dividend income. Let's start with the part most people struggle with, the beginning. When you first begin investing, progress feels almost invisible. You save a little money, you invest it, you reinvest the dividends, and then you wait. Weeks go by, months go by, and when you check your account, it barely looks any different. That's usually when people start thinking something is wrong. But nothing is wrong. Compounding is working exactly as designed. The problem is expectations. Early on, the numbers are simply too small to feel exciting. Imagine you invest $5,000 into a portfolio earning a 3% dividend yield. That produces $150 a year, not per month, per year. Even if those dividends grow at a strong rate, maybe 10% annually, next year you might earn around $165. That's only $15 more over an entire year. You're not going to feel that difference in real life. Mathematically, your money is compounding. Emotionally, it feels like nothing is happening. This is where many people quit too soon. Compounding is not powered by time alone. It's powered by size. Time only magnifies whatever base you already have. When the base is small, the results will be small. When the base gets bigger, growth naturally speeds up. Everyone goes through this slow phase. It doesn't mean your strategy is bad, it just means you haven't reached critical mass yet. So what actually causes compounding to accelerate? Time plays a huge role, but not in the way most people imagine. Time doesn't simply add returns, it multiplies them. For example, suppose you had $100,000 growing at 8% per year. After 10 years, that would become about $216,000. After 20 years, it would grow to roughly $466,000. Nice progress, but still not life-changing. Now add just 10 more years with no extra contributions. That same $100,000 would grow to more than $1 million. Nothing magical changed. The only difference was giving compounding more time to work on itself. This is why investment results are heavily backloaded. The biggest gains happen near the end of the journey, not the beginning. Even small changes in growth rate make a massive difference over long periods. Over 30 years, a portfolio growing at 6% might end up around $574,000. At 8%, it can reach about $1 million. At 10%, it can grow to well over $1.7 million. A couple of percentage points don't sound important, but over decades, they completely change the outcome. Another key lesson is this: starting earlier often beats starting bigger. A small amount invested for a long time can outperform a larger amount invested later. Patience and consistency matter more than trying to get rich quickly. When you run the math long enough, one number keeps appearing. Around $100,000 is the level where compounding starts to feel real. It's not a magic figure. It's simply the point where gains become large enough to notice. A $25,000 portfolio earning 3% produces about $750 per year. That's easy to ignore. A $100,000 portfolio at the same yield produces $3,000 per year. That's real money. And when you reinvest $3,000 annually, the snowball begins to roll much faster. If that income grows at 10% a year, it could turn into nearly $8,000 per year after a decade, without adding any new cash of your own. So compounding doesn't start at $100,000. It starts with the very first dollar. What changes at $100,000 is visibility. That's when progress becomes obvious. Now let's shift from theory to strategy. Income investing has two main components: dividend yield and dividend growth. Yield tells you how much cash a portfolio produces today. Growth tells you how much that income can increase over time. High yield feels good in the short term because it pays you right away. But if that income never grows, inflation slowly destroys its value. Dividend growth is different. It focuses on businesses that regularly increase their payouts year after year. Over long periods, growth becomes far more important than starting yield. The best portfolios balance both. To build something that truly compounds, the companies behind the dividends need to be strong and reliable. The goal isn't to chase trendy stocks. It's to own stable businesses with a long history of paying and raising dividends. A few key rules matter. Companies should have a consistent record of increasing dividends. Payout ratios should be healthy and sustainable. Earnings should be growing over time. The portfolio should be simple and low maintenance. Investing for compounding is not about constant trading. It's about owning quality assets and letting time do the heavy lifting. With that foundation in place, the next step is deciding how to fund the portfolio. There are two realistic paths. The first path uses a one-time investment. You put in a lump sum and allow reinvested dividends and market growth to carry the portfolio forward. The second path relies on steady, small contributions over time. Instead of a big starting amount, you build momentum gradually. Both approaches can work, they just feel different along the way. Let's look at an example. Imagine someone invests $17,000 once and never adds another dollar. With reinvested dividends and long-term growth, that portfolio could potentially reach around $100,000 in a little over a decade. If it continued compounding for 30 years, it could grow into a portfolio worth more than $1 million, generating roughly $5,000 a month in dividend income. Now consider the second path. Instead of a lump sum, suppose someone invests just $7 per day, about the price of a coffee. That's roughly $2,500 per year. Even with no money invested up front, consistent daily contributions could still build a portfolio that crosses $100,000 in a similar time frame and eventually reaches comparable long-term results. The lesson is powerful. You don't need to be rich to start investing. You just need to be consistent. Small amounts given enough time can turn into life-changing wealth. Most people overestimate what they can achieve in a year and underestimate what they can achieve in a few decades. The snowball starts tiny, then it gets bigger, and eventually it becomes unstoppable. If you'd like to see how even a $5 a day investing plan could grow into a portfolio paying more than $8,000 a month, click the video on the screen and I'll walk you through it step by step.